Every trader who blows up an account can point to the exact trade that did it. What almost none of them can point to is the moment weeks or months earlier when they decided that trade was allowed to be that big. That decision didn't feel like a decision. It felt like confidence. And that's exactly why it's the most dangerous moment in trading, and nobody sees it coming until the account is already gone. Today, I'm going to show you why the 1% rule, risking no more than 1% of your account on a single trade, is the single most ignored piece of advice in trading, despite being the piece almost every professional actually follows. And I'm going to show you the specific psychological trapdoor that convinces smart, careful people to break it every single time right before the trade that ends them. You already know the rule. You've heard it in every trading course, every risk management chapter, every beginner mistakes video. Risk 1%. Maybe 2 if you're aggressive. It's not new information, and yet the accounts keep blowing up anyway, which tells you something important. This was never an information problem. If it were, the rule would have already fixed it. It's not that traders don't know the number. It's not that the math is unclear. It's not even that they don't believe it works. Most of them will tell you out loud that position sizing is the most important variable in trading. The real villain is that the rule feels optional in exactly the moments it matters most, and feels mandatory in exactly the moments it doesn't. Let me introduce you to 2 traders. Call them Marcus and Lisa. Marcus spent 6 years as an equity research analyst before he started trading his own account. He is, by any conventional measure, the person you'd expect to succeed. He can read a balance sheet faster than most people can read a menu. He builds a genuinely solid swing trading strategy around earnings momentum, backtests it across 4 years of data, and the numbers are good, a real, positive expectancy edge. For the first 4 months, Marcus risks 1% per trade, exactly as planned. His account grows slowly, predictably, almost too slowly for someone used to outperforming. Then a setup comes along that Marcus is unusually confident in. Not just a good signal, this is different. A stock he's followed for years, an earnings beat that matches every pattern in his backtest, a chart that looks like it was drawn specifically to prove his thesis correct. And Marcus does the thing that ends careers quietly, one account at a time. He decides this trade has earned an exception. He sizes it at 8% instead of 1, not recklessly in his mind, deliberately. He tells himself this is what conviction looks like. The night before he places the trade, he actually writes out his reasoning in a notes app, almost like a legal brief defending the decision to himself. He lists the years he's followed the company, the accuracy of his backtest, the clean technical setup, the fact that 4 months of disciplined 1% trades have earned him the right to size up once. Reading it back, it sounds less like a trader talking himself into a risk and more like a closing argument. That's the tell. In hindsight, nobody writes a legal brief defending a decision they're not secretly unsure about. The trade goes against him the next morning, not because his analysis was wrong about the company, but because a broad market sell-off hits the same day, dragging every position down, regardless of fundamentals. 8% gone in an afternoon on a trade whose thesis about the company itself turned out to be completely correct. It just didn't matter because the market that day wasn't pricing individual companies. It was pricing panic. Marcus spends the next 3 months trying to win it back, sizing up again and again to recover faster, and within a year, the account that grew slowly and steadily for 4 months is down 62%. Lisa was a casino table games dealer for 9 years before she started trading. No formal finance background, and by her own admission, she doesn't fully understand half the setups she trades. What she understands completely is one thing. The house never bets more than the house can survive losing, no matter how good a hand looks. She saw it every night on the floor. A player on a hot streak convinced the run would continue, doubling down past the point any disciplined bankroll strategy would allow, and the house just kept dealing unbothered because the house's edge didn't depend on any single hand going its way. It depended on staying at the table long enough for the math to play out over thousands of hands, protected the whole time by limits nobody was allowed to override in the moment, including the pit boss. She risks exactly 1% per trade, not about, 1%. Exactly. She has a spreadsheet that calculates her position size before she even looks at the chart, and the position size is locked before her opinion about the trade is allowed to form. 4 years in, her win rate is unremarkable, barely above 50%. But her account has grown consistently every single year because no single trade, no matter how good it looked walking in, was ever capable of doing real damage. Not because Lisa was smarter than Marcus. She wasn't. Because she made the sizing decision once, and advance, and then refused to ever let a feeling reopen that decision. That's the whole video, really. Everything else is just explaining exactly why smart people keep making Marcus's mistake, and what it takes to become Lisa instead. Let's talk about why the 1% rule gets ignored, because the reasons are more specific and more sinister than traders get greedy. Root cause number 1: conviction inflation. This is what killed Marcus, and it's the most common trapdoor in trading. The rule isn't broken on bad setups. It's broken almost exclusively on the setups that feel the most obviously correct. A trader will follow 1% religiously through 40 mediocre trades and then blow the rule entirely on the 41st, because that one feels different. But every trader who has ever blown an account can tell you their biggest loss came from a trade they were more confident in than usual. Confidence is not correlated with correctness the way traders assume it is. It's correlated with pattern familiarity, and familiar patterns fail for unfamiliar reasons all the time. Root cause number 2: the invisible cost of discipline. 1% risk, applied consistently, produces returns that feel almost insultingly slow, especially in the first year. There's no dopamine hit in a strategy that grows an account 8% a year. So the brain starts treating strict sizing as the obstacle standing between the trader and the returns they actually want, rather than the mechanism that makes any return possible at all over the long run. The 95% see 1% risk as a ceiling, holding them back. The 5% see it as the floor that keeps them in the game long enough to compound. Root cause number 3: survivorship blindness. Traders who size up and get away with it become the loudest voices in every trading community. The person who risked 15% and doubled their account in a month posts screenshots. The 9 other people who risked 15% and got wiped out never post anything, because there's no account left to screenshot. This creates a completely distorted picture of what aggressive sizing actually produces, because you're only ever seeing the survivors. The 95% calibrate their own risk tolerance based on the visible winners. The 5% understand that for every screenshot of a home run, there's a graveyard of accounts you're not being shown. Root cause number 4: the one trade fallacy. Most traders evaluate position size trade by trade. How much am I comfortable risking on this specific setup? Instead of evaluating it across the full sequence of trades they're going to take over years. But position sizing was never a single trade decision. It's a decision about how many consecutive losses your strategy can survive before the account is structurally damaged. A string of 5 losses at 1% costs you about 5% recoverable in a normal month. A string of 5 losses at 8% costs you close to a third of the account, and that math doesn't come back with the same strategy that lost it. The 95% size for the trade in front of them. The 5% size for the losing streak, that hasn't happened yet. Root cause number 5: emotional recalibration after a win streak. This is quieter than conviction inflation, but just as dangerous. After several consecutive winners, 1% starts to feel unnecessarily conservative. Not because of one specific trade, but because the whole account feels like it's working. And the trader unconsciously recalibrates what feels like an acceptable risk. Sizing creeps from 1% to 1.5% to 2 to 3, with no single moment where a rule was consciously broken. It's not a decision. It's a drift. The 95% let their risk tolerance float with their recent results. The 5% keep the number fixed regardless of whether the last 5 trades were wins or losses, because the number was never supposed to be a reflection of mood. Root cause number 6: mistaking account size for risk tolerance. As accounts grow, the same 1% represents a bigger dollar figure, and that bigger number starts to feel psychologically different even though the underlying risk to the account is mathematically identical. A trader who was disciplined at 1% on a $10,000 account sometimes starts negotiating with themselves at 1% on a $100,000 account. Because now 1% is $1,000 instead of 100, and $1,000 feels like a real number. The rule didn't change. The dollar amount attached to the same percentage just started triggering a different emotional response. Root cause number 7, borrowed conviction from other people's risk. Trading communities, group chats, and social feeds are full of people sharing position sizes that don't match their own risk tolerance, their own account size, or their own track record. A trader watching someone else risk 5% and win doesn't see the 8 other times that same person risked 5% and lost, because the losses rarely get posted with the same enthusiasm. This creates a distorted sense of what normal sizing looks like. And disciplined traders slowly recalibrate their own number upward simply because everyone around them seems to be sizing bigger. The 95% let the group's visible behavior set their own invisible baseline. The 5% size, according to their own account, and their own survival math, regardless of what size is trending in the community that week. Now, here's what to actually do about each one of these. Because naming the trap doesn't disarm it. A specific counter behavior does. Shift 1. Pre-commit your size before you're allowed to form an opinion about the trade. Lisa's spreadsheet calculates position size the moment a ticker enters her watch list, before she's read a single headline about the company. By the time she has a feeling about the setup, the size is already locked, and the feeling has nowhere to attach itself. If you build your excitement about a trade before you calculate the size will always bend toward the excitement. Reverse the order, and the excitement has nothing left to negotiate with. Shift 2. Treat 1% as a speed limit, not a suggestion with exceptions. Speed limits don't have a clause for unless you're a really good driver and this road looks empty. The rule works precisely because it doesn't bend for confidence. Write your 1% rule the same way. No clause, no unless it's a really clean setup, no exception for conviction. The moment you build in an exception for high confidence trades, you've built the exact trapdoor that took down Marcus. Because every account-ending trade in trading history walked through the door labeled "this one's different." Shift 3. Size for the losing streak, not the winning trade. Before you ever decide what feels right to risk, run the math on 10 consecutive losses at your intended size. If 10 losses at your current risk would take out more than 15 or 20% of your account, your size is too big regardless of how good any individual trade looks. This reframes the entire decision from how much am I comfortable losing on this trade to how many of these can I survive in a row, which is the actual question that determines whether you're still trading in 5 years. Shift 4. Build a hard ceiling that doesn't move with your feelings. Pick your number, 1%, 0.5%, and write it somewhere you'll see before every trade. Not a range, not a 1 to 3% depending on conviction. A single fixed ceiling. Ranges are where drift lives, because a range gives your emotions room to negotiate within boundaries that feel reasonable on paper, but compound into disaster over time. Shift 5. Recalibrate size to account value on a fixed schedule, not in the moment. Instead of unconsciously adjusting how a given dollar amount feels as your account grows, recalculate your 1% explicitly at fixed intervals. Monthly, say, using the actual current balance, and then don't touch that number again until the next scheduled recalculation. This removes the sneaky psychological negotiation that happens when a bigger dollar figure starts feeling like a bigger decision than it mathematically is. Shift 6. Audit for drift, not just for losses. Once a month, look back at your position sizes across every trade, not just the ones that lost. If you find your size crept upward during a winning stretch without a single conscious decision to increase it, that's the pattern to catch before it meets a losing streak. Drift is invisible in real time and completely obvious in hindsight. The only fix is checking for it on a schedule instead of waiting to notice it after the damage is done. Shift 7. Size your own account, not the group chat's highlight reel. If you're in a trading community, treat every shared position size as unverifiable marketing until proven otherwise. You have no idea what that person's account balance is, how many losing trades they didn't post, or whether they'll still be trading in a year. Your 1% should be calculated from your own balance and your own survival math, completely independent of what size feels normal to the loudest account in the room that week. Here's the identity shift underneath all of this, because none of these 6 shifts will hold under real pressure unless something deeper changes first. Right now, you probably think of position sizing as a technical setting, a number you adjust based on how good the trade looks, the same way you'd adjust volume on a stereo depending on the song. That framing is the entire problem, because it treats sizing as a response to the trade instead of a boundary that exists independently of any trade. The 5% don't think of position size as a response to opportunity. They think of it as a structural limit, the same way an elevator has a weight limit that doesn't change based on how important the people getting in feel that morning. Nobody argues with an elevator that it should carry more weight today, because the meeting is important. The limit exists precisely because it doesn't care how good the reason is, and that indifference is the entire feature, not a flaw someone forgot to fix. Think about how strange it would sound if an elevator's rated capacity changed, depending on how confident the passengers felt about the cable. Nobody would accept that logic in a building, and yet it's exactly the logic most traders apply to their own account every time a setup feels convincing enough to justify sizing past their limit. The building's engineers didn't calculate that weight limit based on your mood on a given Tuesday. They calculated it based on the worst-case load the structure could take before it failed, and they built in a limit that holds regardless of how the day feels. Your position size deserves the same kind of indifference to your mood. When you stop treating your risk per trade as a response to conviction and start treating it as a fixed structural limit that exists independent of every individual trade, the entire psychological trapdoor collapses. Because there's no longer a decision to make in the moment. There's only a number that was already decided, weeks or months ago, by a calmer version of you. And here's the part of this video that's going to feel like a letdown, because it's supposed to. If you're doing the 1% rule correctly, it will not feel meaningful most days. A 1% loss barely registers. A 1% win barely registers. There's no adrenaline spike either direction, and that flatness is not a sign that you're being too conservative. It's the entire point. The rule is working precisely when no individual trade feels significant enough to talk about, because the significance was never supposed to live in any single trade. It was supposed to live in the compounding of hundreds of trades where no single one had the power to end the account. This is uncomfortable for the same reason all boring truths in trading are uncomfortable. Most people didn't get into trading to feel nothing. They got in for the story of the trade that changed everything. But the traders who actually survive long enough to compound real wealth describe their risk management as almost invisible in daily life. A number in a spreadsheet they stopped thinking about years ago, because it was never supposed to be a live decision. It was supposed to be a solved problem. So let's go back to Marcus and Lisa, because that's where this actually lands. Marcus, after his 62% drawdown, does something that takes more humility than most people can access after a loss that size. He doesn't abandon his strategy. The strategy was never the problem, and his backtest proves it. He rebuilds the account from what's left, and this time he removes his own ability to override the size. He automates his position sizing so the number is calculated and locked before he's read a single headline about the trade. 2 years later, he still occasionally sees setups that give him that "this one's different" feeling. The difference now is that the feeling has nowhere to go, because the size was already decided by a version of him who wasn't looking at that chart yet. Lisa is still doing exactly what she was doing 5 years ago. Same spreadsheet, same fixed number. Nothing about her process has gotten more sophisticated, because it was never supposed to. Her account has simply had 5 more years to compound without a single trade capable of undoing the previous 4 years of work. So here's the actual choice, and like the rule itself, it's binary, not a range. You can keep treating your position size as a live decision that bends toward whichever trade currently feels the most convincing, which guarantees that eventually the trade that feels the most convincing will also be the one that costs you the most. Or you can fix the number before you ever look at the chart, refuse it, a single exception, and let something that feels almost insultingly boring do the one job excitement was never capable of doing, keeping you in the game long enough for the edge to actually show up. The trade that ends most accounts was never the one that looked risky. It was the one that felt safe enough to break the rule for. So the only question worth asking before your next trade is simple. Did you decide the size, or did the trade decide it for you?